Strategy often revolves around expansion. Open new locations, hire aggressively, increase production capacity, launch new product lines. When demand feels predictable and capital is accessible, building fixed infrastructure appears logical. Scale drives efficiency, and efficiency drives margins. But when volatility enters the picture, the logic changes. In 2026, one of the most powerful yet understated competitive advantages in business is a flexible cost structure. The strategic advantage of flexible cost structures lies in how quickly a company can adapt when conditions shift. It determines whether a business absorbs shocks or struggles under them. To understand why this matters, consider the difference between fixed and variable costs. Fixed costs remain constant regardless of revenue levels. Long-term leases, permanent headcount, owned facilities, and heavy capital expenditures create operating leverage. When revenue rises, profits can expand rapidly. But when revenue falls, those same costs become burdens. Variable costs move more closely with demand. Outsourced services, cloud-based infrastructure, contract labor, and usage-based agreements allow expenses to scale up or down. Margins may not expand as dramatically during booms, but downside risk is reduced. In uncertain environments, flexibility becomes insurance. Over the past several years, businesses have faced unpredictable demand cycles. Consumer spending patterns have shifted abruptly. Supply chains have experienced disruptions. Energy prices have fluctuated. Geopolitical events have influenced trade flows. In this context, companies with rigid cost bases often find themselves forced into reactive measures, emergency layoffs, asset sales, or rapid cost-cutting programs. Those with flexible structures can adjust gradually and strategically. Technology companies offer a clear example. The move from owned data centers to cloud infrastructure was not just about convenience. It introduced cost variability. Instead of investing billions upfront in hardware that must be utilized to justify its cost, companies can rent compute based on actual usage. When demand rises, they scale. When demand slows, they optimize. Similarly, subscription-based software models create more predictable revenue streams, while allowing businesses to align expenses with user activity. Manufacturing firms are also rethinking fixed investments. Rather than building large single-country production hubs, many are diversifying suppliers and using contract manufacturing arrangements. This reduces exposure to regional disruptions and spreads risk across multiple partners. Flexible cost structures also influence hiring strategies. Permanent expansion of payroll increases fixed overhead. Many organizations now blend full-time staff with project-based specialists, consultants, and automation tools. This hybrid model allows companies to maintain core capabilities while adjusting labor intensity based on workload. The strategic advantage is not just defensive. It creates offensive opportunities as well. Companies with flexible cost bases can pursue growth during downturns when competitors are constrained. They can allocate capital toward acquisitions, product development, or market expansion because they are not overwhelmed by fixed obligations. In other words, flexibility creates optionality. Investors recognize this. Businesses that demonstrate variable cost management and operational agility often command stronger valuations in volatile markets. Predictable margins combined with adaptable expense structures signal resilience. There is also a psychological dimension inside organizations. When leadership knows that costs can be adjusted without destabilizing the company, decision-making becomes more rational. Panic-driven reactions decrease. Strategic planning becomes more balanced. Teams can focus on long-term positioning rather than short-term survival. The strategic advantage of flexible cost structures becomes especially clear in high-growth industries like artificial intelligence. AI infrastructure can be capital-intensive. Training models requires compute clusters, energy agreements, and engineering teams. Companies that structure these investments with scalability in mind, using modular data center expansions, usage-based contracts, and phased hiring, reduce the risk of overcommitment. If demand accelerates, they expand. If it stabilizes, they adjust without dramatic restructuring. Retail and consumer businesses are adopting similar principles. Inventory management systems driven by real-time data allow for leaner stock levels. Logistics partnerships reduce the need for owned distribution networks. Digital marketing platforms enable variable spending aligned with measurable results. Every element of the cost base becomes a lever. However, flexibility does not mean instability. Core capabilities must remain strong. Excessive outsourcing or over-reliance on temporary arrangements can erode institutional knowledge and quality control. The key is balance. Strategic flexibility requires identifying which costs should remain fixed because they define competitive identity, and which can remain variable because they are operational enablers. This distinction is increasingly part of boardroom discussions. Capital allocation decisions now consider not only return on investment, but also reversibility. How easily can this investment be scaled back if conditions change? What portion of the cost base becomes permanently embedded? These questions shape expansion strategies. The broader implication is that business cycles are no longer viewed as rare disruptions. Volatility is becoming normalized. Companies that assume smooth, uninterrupted growth risk overextending. Those that embed flexibility into their operating models are better prepared for rapid shifts. The strategic advantage of flexible cost structures is therefore about survival and growth simultaneously. It protects downside exposure. It preserves capital. It enhances strategic agility. It allows management teams to act deliberately rather than reactively. In a world where demand can fluctuate, supply chains can tighten, and technological